let's begin with, we'll come back to many of the debates you just heard about active versus passive. But can we just begin with some stuff in the news? What makes you most worried at the moment out of Brexit or the euro area economy?
Oh, without a doubt, Brexit, because I think the two are linked, obviously. If we have an unmanaged Brexit, and I'm not telling anybody anything new here, I think that has a significant impact on the UK economy. That has also a significant impact on the Eurozone economy, so it's sort of reinforcing. So I think Brexit worries me also for the political signals it sends. Let's not forget that the vote to leave the EU took place before the US election. And I think all these events have signaled something to the rest of the world, and I think right now it's self-reinforcing.
I saw earlier this year you said you thought a hard Brexit could not happen because it would just be too irresponsible. Do you now think a hard Brexit is possible?
I think it's possible because some of the players involved in the discussions seem to be, at least in terms of how they're talking about the process, seem to be contemplating very irrational moves, potentially illegal moves. So it's very difficult to predict now.
And going in terms of you as a big manager, you have 543 billion euros at the end of last year, 343 in third-party funds. How do you plan for that? What is your Brexit scenario that you're treating as?
Well, I think we need to differentiate between what the impact on the investment strategies and the impact on the business itself. Perhaps taking the latter first, I think it's interesting to note that we've not really tried to predict the post-Brexit regulatory landscape beyond the reassurance that we've received from the regulators that even in the case of a hard Brexit, not too much would change for our business. So we've actually grown our headcount in the UK by about 30 or 40% since 2016, mainly in the area of non-public market investments. If we look at the investment strategies, clearly that's a whole different ballgame. And Brexit coupled with the trade stresses that we're seeing in the global system and a slowdown in the global economy, all that taken together means that we're probably much more cautious than we were 6-9 months ago. I would think that many of our portfolio managers, but not necessarily all of them, are probably very cautious on sterling and also, as I said, probably cautious on UK equities as well.
What about the euro area? I saw the other day, especially given your sort of German heritage, I saw the other day a picture in Bild which showed Draghi as a vampire sucking out the blood of German investors.
Yeah, I think low interest rates are really a significant issue for countries that have demographic challenges such as Germany and also excess savings. People who are used to living off fixed income securities and money market funds no longer have a return, so that increases savings. That then means, of course, there's less consumption. That has a depressing impact on the economy. That then leads to lower rates. So it's pretty self-reinforcing. Now, I think the answer to that really needs to be, and this is where I think it's quite helpful that Christine Lagarde is coming in as a new ECB governor. So this is the post-Draghi era. Christine Lagarde has some significant experience in terms of handling the politics, not necessarily just the monetary politics of the situation. And I think she'll be engaging with European policymakers so that perhaps we can see more of a compact that would see fiscal policy and monetary policy work in tandem, which has not been the case since the great financial crisis, where monetary policy has gone one direction and fiscal policy has gone in the different direction. So it's not been very helpful.
Out of interest, who do you blame more for that? Do you think Draghi actually did he save the euro area, or has he?
Without doubt, without what Draghi has done, the euro would have collapsed. I think most people in the room would agree with that here. But there comes a point, and that goes not just for the quantitative easing policy of the ECB, but also for the Fed and the Bank of Japan, where one needs to move to a different policy framework, simply because the policies that have been in place now for 12, 13 years are not working, and they're not addressing the 2007-08 crisis anymore, which they did correctly, but they're not achieving the policy aims, which is to have inflation run at 2% per annum, and therefore we need a closer cooperation between monetary and fiscal policy to move us forward.
But in general, you would like to see more accent on the fiscal policy rather than the monetary side?
Absolutely, because monetary policy has not delivered in the last 5 or 6 years in terms of what central bankers have tried to achieve, which is to have inflation run at the target rates.
We'll come back to the difficulty of doing active management against that in a second. But just one thing, so you mentioned it, the trade war. What is your kind of best guess? What is the scenario that, from your perspective, you're expecting between China and America? Do you now see it as a world of two economies, two internets, or it's going to become that way?
Again, I think the announcements and the players are so erratic right now. We saw this morning, I saw on your screens, that the Chinese had banned the NBA broadcast from state TV because of a
tweet.
Somebody had
player
said something.
tweeted.
So I think it's all so erratic that it's very difficult to predict. My best guess is that in terms of the context of the U.S. elections, it's in the interest of the U.S. administration to somehow present a trade deal, an agreement which looks like America has won the trade war. Now that's how it's going to be portrayed. Whether anything in reality much changes, I doubt. But that's my central scenario. But as I said, it's
so you'd expect a deal on tariffs, but the underlying animosity and
challenges will remain. And I think we're really engaged in a long-term, Cold War in tech. Would be what that's all about.
In terms of investment, just quickly on that, how do you structure that if you end up with, I suppose, two global economies?
It's very difficult to predict. My sense is that at some point we're going to see profit margins globally come under significant pressure for global corporations, and that coupled with a different interest rate environment and monetary policy framework may then well have a significant impact on valuations of those global corporations. How they respond to that will obviously determine how much they will be impacted, but I would have thought that all other things being equal, and this is a complex question, will probably favor domestically orientated or companies in that environment.
Because you would end up with more regional stroke domestic economies. I just come back from Asia where people were taking that approach. I was going to ask you about a fund you set up last week, which I thought was really interesting, which is a private market debt and equity impact fund, but it's aimed basically at dealing with energy efficiency, sustainable land use. It's sort of, I suppose, based around climate change to some extent. Why did you do this, and can you just explain how it will work?
Well, I think
especially the private aspect.
Yeah, I think Michael Bloomberg had a bit to do with that. He called into existence the Global Climate Finance Leadership Initiative, which brought together a number of large corporations from the financial sector and the non-financial sector to try to address jointly the challenges that we have around climate, but also around some of the other UN development goals that have been put out, such as clean water and so on. And really that focused our minds on this. We were starting to have conversations with clients who said, look, we like financial market returns, but we also like to measure what sort of externalities a fund like that can produce and our investments can produce, because we want to see that it has an impact, on some of these goals that we care deeply about, and that's how the fund came into existence. So client demand always comes first. I think talking with all these other organizations, I think gave us the confidence that there would be sufficient resources available to launch this. And interestingly, even though the market overall for these non-public market impact securities is only 500 billion, we see this growing very fast. And over the next few weeks, we'll be announcing the sum of this fund as well.
How do you think investors will measure the performance, though? I mean, what are the kind of benchmarks against which you can judge yourself?
Well, I think that's difficult to say, and it's in development. It's very different from sector to sector, but clearly they're looking to us to give them some guidance. We expect to be delivering progress on some of these goals on a quarterly basis, whether that's the carbon footprint of a particular investment, whether that's the impact on the water supply, on the inputs. So it's going to be very specific per investment, and it's going to be very regular. And I expect that once we start reporting, clients will understand this better. They will ask us further questions, and then we'll evolve it as we go along.
You can understand the sort of, I suppose, the worry would be this is a combination of two quite opaque things. There's private stuff, and there's also green stuff, which there isn't that many ways to measure either.
Yeah, I think obviously if you're implying the sort of the greenwashing aspect of it, I think firstly too much is made of that. Secondly, I think it's particularly a risk potentially in the public market space, but I think in the private market space, where the dialogue between the investors and ourselves who put the money to work is very, very intense. I think there's very little risk of that, actually, because people really own these decisions with us.
It must have been all the way around this room. I suspect there are people whose investment funds have been, ESG is becoming a bigger part. Within sort of Allianz, how big a role is it playing? Is there a dedicated force? How do you structure it?
It's very important. We have really the whole spectrum of what I would call sustainable investment options, from all of our portfolios, which are today ESG informed, to ESG integrated, where I expect almost 100% of our portfolios will be in about 18 months, to what we would call sort of SRI investing, meaning investments that are really restricted in terms of the investment universe in one way or another, and then towards the non-public markets fund side, which is what we just talked about, which is the impact side. We've got the lot. For the SRI piece, we have a dedicated research team, because SRI research is special in the sense that it focuses the investment universe on a reduced opportunity set. The integrated ESG piece, which is the majority of our assets, we expect every PM and analyst to integrate that into the investment process. And so we have an internal, if you will, process that verifies that once a portfolio management team claims to be ESG integrated, that's actually the case. So we have a team that verifies that and gives them a label, if you will. One
quick thing, a sort of mystery to many of us looking from the outside is there any kind of, have you learned any lessons from what kind of investors are interested in this? Is there any kind of geographic side? Is there something that European investors want, American investors want? Is it global, or are there obvious trends that you stand a better chance of selling this stuff to people who are for some regions or interested in particular things? Is there anything that comes through?
Yeah, absolutely. I think if you go back 10, 15 years, this was principally around SRI investing and came out of continental Europe. More recently, over the last 3 or 4 years, I would say that the client interest in integrated ESG is global, and it's pretty equally intense across the regions. Where it becomes a little bit more complicated is the regulatory framework and the fiduciary responsibilities that we have and how we deal with that. And there, Europe is actually quite advanced. We were part of the technical expert group of the European Commission trying to determine some of the taxonomy of this sector. And I suspect that we'll have some regulations around how certainly public funds should be investing in this space. In the United States, of course, it's a little bit more tricky, particularly under the current administration. And therefore, one needs to be very cautious and also careful in terms of how one presents integrated ESG. For us, it's always been about getting the best of both worlds, meaning focusing on the long term while still aiming for the highest possible risk-adjusted return. And as long as you can prove that or demonstrate that, then I think it's okay in the United States as well. But I think the SRI angle is clearly one that US regulators are less comfortable about.
You saw, as we walked in, we saw the last panel, and we showed 63% of people basically favouring passive investment from this obviously well-selected audience. But secondly, you are an ultra activist. You look at your website; it's always active is, and you say those are the two most important words in the way Allianz thinks.
Absolutely.
How would you defending active management at this precise moment? Why does it work?
Well, I don't want to reiterate what much of this panel has said, and I sort of probably got about 70% of it before we got chatting and were waiting in the wings here. But I think taking the value for money point that was sort of up on the screen, the 63% saying, it doesn't pay for itself. I think that's an important one. I'm not sure that the panel, maybe I missed it, but delved in that enough. I think while I agree with you on that 30% share of the value that's created is probably appropriate, in my mind, a lot of the product, particularly that's accessible through the retail market, is still too expensive to the end investor, partly as a result, UK accepted of distribution fees being bundled up, but also partly as a result of the fact that too many active funds still charge for beta. And so we're moving much more towards a fee-sharing arrangement type of proposition for most of our clients where we can. And I think that's got to be part of the way to address this. You only get paid if you outperform. And that's then when the 30% come in. But that's still not the case sufficiently I think, end investors to feel that they're getting value for money. I think that's one aspect.
I checked. I think it was 51% that your third-party money was outperforming at the end of last year. What number would you? I mean, obviously you'd want to have 100%, but what's a reasonable target?
Well, I think it depends a little bit on the asset class. You'd want to have a slightly higher proportion for fixed income securities, maybe slightly lower for equities, but on average sort of 70%. You would want to obviously have all the non-public market investments always outperform. Now, we have 77 billion of those. They're not part of any performance metric. But I think it gets me to, I think, a very other fundamental point when it comes to active versus passive, which is, I think the investment proposition to the end investor has to be more than actively outperforming an index benchmark, particularly in the equity space. There is more. I think some of that was mentioned here on the panel in terms of how we engage with companies, the ESG angle. But I think there's even more than that. I think one of the reasons why active has failed to justify its value to many end investors is because the investment proposition of the last 40 years has been narrowed down too much to single individual benchmarks and its universe, particularly in the equity space. So, of course, if you invest in an equity benchmark and you can only invest in the securities that are in the benchmark, then I think Paul's point earlier, which is, for those who outperform, there's got to be the same amount of underperformers, is correct. But I would challenge that, because more broadly for active, that is certainly not true. Take the case of FX hedging. If you take a view on a currency direction, somebody else will take the other side. The other side, the person who takes the other side, will be the person who wants to hedge their exposure. You may be right in terms of your directional view, and you make money. That doesn't mean the other person loses, because they got the hedge and therefore the safety, and they got the rate that they were bargaining for. So there's no loss there. So there's a win-win situation. And I think more broadly speaking, therefore, if active investors and their clients agree on a broader opportunity set from which they can choose from, even if a benchmark is much more narrower, then I think active managers have a much bigger chance to outperform over time.
Well, just from an industry point of view, the other bit is scale, takeovers. You've talked a bit about how important scale was. You was talk of a merger, as you know, earlier this year with DWS, and your name is still pushed around. I know Bloomberg. When Bloomberg talks about something, it's always accurate. But when you recently said to another less noble financial newspaper that a large-scale merger could help. Do you think do you still, have you changed your mind on this a bit?
I don't think I've changed my mind on that. I think the basic proposition that scale matters in this game for global asset managers with a large offering is very true. Because the cost of doing business are going up all the time. The cost of distribution is going up, the cost of regulation is going up, the cost of capital is going up. And clients are rightly, I think, asking more of their asset managers in terms of customization, in terms of product development. And so if you want to be in the game, you need a lot of optionality in the system. You need to be able to offer a very diverse set of services. And that requires a lot of money, and therefore scale can help you with that. If you're not big enough, you just won't have enough money to invest in the IT that supports all of that, the infrastructure that supports that, and of course the talent that supports all of that.
And do you think we've seen so far most of the scale on the passive side rather than the active side? Is that the problem?
I'm not sure that that's the case, because what your question is implying is that somehow the passive players have done better out of that because we had more scale.
Yeah.
As it happens, if you look at the studies that have been done over who owns what portion of the profit pool in the asset management industry, it's still 90% plus the active industry, because passive's not making that much money. But I do think that on the active side, not enough players have made up their mind in terms of, let's not call it the active side, the hybrid side, because most asset managers are hybrids of active, passive technology companies, and not enough of those players have made up their mind actually where they want to play. And I think that's hampered the development of true scale on the active side. One or two players accepted.
Do you sense that there's about to be a wave of mergers? I mean, there's already been a few.
We've seen a few, and I expect that fully to continue.
One last bit, just later. This is genuinely, I have convinced the audience a coincidence. I'm due to interview Manny Roman, who is a sense your corporate cousin, both owned by the same company. Well, what would you ask him? Sorry, the head of PIMCO, I should say.
Interesting. I heard Ewan Monroe earlier talking about structural alpha and structural beta, and he made the point, I think, that many asset managers charge for structural beta when they should only charge for structural alpha. I think that would be a good question for many.
I remember to do it. Andreas Utermann, thank you very much, CEO of Allianz Global Investors.
Thanks.
Thank you very much.
Thanks a lot.